Chicago conferences where you're going to be participants after a few preliminary subjects or a couple or three or whatever we do. It's a lot of fun. It answers your questions. It answers our questions. We might knock heads a little bit, but it's all in good fun, and it's all to learn, and it's all to enhance our knowledge. So in a way, this is kind of old home week here. I'm going to start with the ladies. And joining us remotely is Lyric Hughes Hale. Some of you remember that after the 2008 crash, her late husband David was here and the keynote speaker. When Lyric and I were visiting the other day, I shared with her that, and I told you all this story earlier today about my early days in the financial business and getting blindsided by a very big event in the markets and not knowing the answers and trying to figure out which end was up, and one of the very first economists that I began to follow was David Hale. And he made a lot of sense. What he had to say resonated with me, and Lyric is carrying a torch. She has her own consultancy, her own podcast. And Lyric, for just a few minutes, tell the folks about yourself and what you're doing these days to bring us all up to date.
I would be happy to do that. First of all, I'm so happy to be here. Thank you, Eric, and thank you, Chris. This conference was one of David's favorites. And he went to the World Economic Forum and the IMF meetings and places all over the world. But this conference held a special place in his heart. And I think he realized very early on the importance of natural resources, energy and commodities and so forth. So I'm really happy to be here to talk to you. I think I drove him to the last meeting and dropped him off. So here I am virtually. This was before the days of Zoom, right? But so I run a company, two companies, one called EconView, and that is a media company. We have podcasts, the Hale Report, and also we do a newsletter, which is free. So if you go to EconView, econvue.com, you can sign up, and I'd be very pleased to have you as a subscriber and a commenter as well. And I also run a consulting company called Hale Strategic. So that's really about me. I've got 5 kids and 2 grandchildren, and my offices and my home are in downtown Chicago.
Great. Well, thank you, Lyric. To my immediate right, also speaking of Old Home Week, is Connie Harrison. And for a lot of years, we all knew and loved her late dad, Clyde. The two of them, speaking of commodities, as Lyric just did, how many of you remember the Rogers Raw Materials Index that was started years ago influenced by Jim Rogers? Anybody remember that? Mm-hmm. All right. Well, Connie and her father set up that index. And Connie, like yours truly, was early in her career, was a conventional financial planner / investment advisor. Like yours truly, decided that we weren't doing the best for our clients by doing what we were told and being robots and so forth. And so she has gone on to things that are more important and more helpful to people rather than to firms. And so Connie, tell us a little bit about that journey and what you do now.
Well, I evolved with my father, launching the Rogers International Raw Materials Funds. I was also involved with Euro-Pacific Capital. So I was fortunate to be on the disruptor side, if you will. Am I? Yeah, right up in there. See, usually I don't even need one of these. That's the issue that I'm having here. Oh, good Lord. I'm afraid of this thing. Anyway, so I've always been very passionate about new ideas and innovative things and passionate people that love what they do. As to Chris's point, as the financial world evolved into insurance people that could suddenly recommend investments and the downsizing of the discount houses and the smaller firms, I was a bit disenchanted, and I started doing financial concierge because I thought, well, people need to know who they're working with and make sure that they're working with the right people. Well, that went great until people decided that asking Fred down the street was a lot less expensive than hiring Connie to interview different financial firms. So it has evolved, and hopefully what I bring to the table is the communication side. I basically teach people how to talk to money and about money. So capital raises, difficult family conversations, making sure your financial team is paying attention to you and not to each other. And the other human element is the animal therapy world. So I have a shepherd mix that we are nationally registered with Pet Partners. So we go around to hospitals and schools and events, and our job is to make people smile. So hopefully I can make people smile on a variety of levels. So that's what I am all about, Mr. Temple.
Well, thank you, and we're smiling because you're here.
Thank you, I appreciate that.
Next down the line is Bill Powers. Bill is one of the up-and-comers, like Rob Keentz you'll meet next. He's got a great presence on the internet and social media. He's the proprietor of Mining Stock Education. I've been privileged to be a guest on his program on a number of occasions. And Bill is about taking a lot of these macro things that we talk about and putting them to work and finding investment opportunities. So Bill, tell us a little bit about your journey.
About 8 years ago, I was running a construction company in Metro Detroit, come from a small business background, also worked in the non-profit sector, and I began investing in gold 2012, 2013, and buying physical silver in my own possession. And my average cost basis for silver was probably between $20 and $22 per ounce. Yet the price of silver kept falling and falling and falling going into the end of 2015, where it went under $14 per ounce. And so I said to myself, well, I have all this physical silver as a means to preserve my purchasing power, but now I want to make some profit on a leverage play on what I expect to be the rising price of silver. And that caused me to look at junior mining stocks, just looked at some silver juniors that were down 95% from 2011, 2012, bought a bunch of those, and over the next 6 months, I purchased them on, I believe, January 21st, 2016, a lot of them, which was 2 days after the bottom. And so for the next 6 months, they just went up, and they went up, and they went up, and then I found myself sitting on tenfold gains in 6 months, having no idea what I was doing. So I said, well, how about I try to find out what I'm doing, because if I can do this not knowing what I'm doing in the right macro environment, maybe if I really figured this out, I could do really well over a period of time. And so I began to look for educational resources. What is a retail investor in the junior mining sector to do? Where can I find some good resources? At that time, in 2016, there really was not a lot on the internet. So by the end of 2016, I said, well, I'm running this construction company on the side. I'm going to start a show. I'm going to call it Mining Stock Education, and I'm going to talk to smart people in the sector, and I'm going to figure out how to do this and hopefully produce some content that others would find valuable as well. Began to go to all the investment conferences like this, meet people. Eventually, I had a bunch of sponsors approach me, asked to sponsor the show. And a year and a half or so later, left the construction company behind, and I've been doing this full time now for 3.5 years.
Nice. Great, thank you, Bill. Rob Keentz, next to him, similarly is one of the new guard, if you will, in the resource industry and where precious metals are concerned. Young staff that he's got, some energetic people. He's built himself up quite a presence with Gold Silver Pros, which I've also been on. And with his newest, broader outreach, Financial IQ TV, right, Rob?
Yes, so I'm Robert Keentz, and I spent about 25 years in the technology space. I have 3 degrees in technology, including a master's of information assurance, which many of you may know as cybersecurity. And my last corporate role was working for Verizon as their lead network security risk management analyst on their 5G network, which is their, the new global 5G rollout. I, similar to Bill, left my job last year, and I work full-time now analyzing investments. I started about 12 years ago writing for Seeking Alpha, got syndicated across Yahoo Finance and NASDAQ and MarketWatch and a bunch of other websites, and was invited by some of my friends to do social media. So for the last 2 years, I've been doing a lot of YouTube, Twitter, LinkedIn, and connecting with people who are interested in the precious metal space. I originally, however, did not start out as a gold and silver investor. I started out in real estate I ran 2 real estate investment companies as a side gig for about 18 years in Dallas-Fort Worth. Also received financial licenses, Series 3 commodities, and also 6, 63, and 7, I believe, in financial services, to educate myself along the way about personal finance, and worked for some companies along the way, a Forex broker and a broker-dealer, to learn general financial principles. So I kind of put all of that together and decided to form Financial IQ Television. And my idea with Financial IQ Television is to expand upon what we built at Gold Silver Pros, which is a research and education service to help people understand how to invest in different markets. But I want to go beyond the precious metals, because I believe, as this conference will highlight, there's opportunities, across the board in different financial asset classes. And I want to try to democratize that information for people, so it's not sitting behind a paywall or a membership, but people can come to the site as we interview various experts, and they can pick up that information for free.
Great, thank you, Rob. And finally, Dr. Lee Warren down at the end of the table, who is another of the older hands at the Chicago Resource Expo and now Strategic Investment Insights. Lee is the founder of a very unique organization called PLIM, which stands for Power Latent in Man. Tell us about that, Lee.
Well, the power latent in man was furnished. Well, see, I graduated from DePaul in 1971, and with cum laude in mathematics. I worked for Allstate, worked for some of the big companies. I wound up at SIIC as a financial portfolio manager. And I managed today, in today's money, that was about $40 million back then. Today, that'll be about at least 10 times that. So that's about $500 million. A portfolio manager, I worked there, then moved on to Allstate. But I had a number of spiritual experiences that I was in a mid-air plane crash. I was a pilot, and Piper Cub and Cessna, we hit about 3,000 feet up and lost vertical stabilizer, left stabilizer. I looked out at my left window and I saw, oh hell, is this it? Because all I saw was like a zero plane. Bunch of smoke, he had crashed. I said, I'm next. And by miracle, we were spared. Did a little stuff of concussion. And that led me back into the ministry, and I founded the organization, The Power Latent in Man. I had a number of other challenges in life, in a coma for 21 days from blood poison, the flesh-eating disease. Almost died from that, cancer, you name it. I've been through a stroke. So, as my sister said, you got more lives than a cat. So that's how the Power Latent in Man is formed. It's a unique organization. We deal on the both physical, psychological, and spiritual level. The things that you need to get through this life, providing guidance to lead you, especially at this time, since we have such a great crisis. And what we consider one of the biggest crises that I think is the foundation of this is our money system is in one hell of a situation. And this is not unique. It happened with the Roman Empire, the Babylonian Empire, the Assyrian Empire. You can come all down through the ages and dispensation. And the scripture said, and money failed in Egypt with Joseph, and money failed. They didn't have paper money. They had coins, and how they would debase silver, they would use what? Zinc. And the currency becomes what? Worthless. And that's what we're at the point now. If you don't believe it, just keep going to the grocery store. You don't have to have a master's degree from the University of Chicago. You don't have to have a PhD. You can just be a common individual. You go to the store, and all of a sudden you realize that the wages you get, something's wrong. And that's what we face tremendously today. And our government has, I call it malfeasance, and caused this crisis. This is worldwide. So we face something, and there are things that we can do as an individual, collectively, outside, as I call it, deregulation, outside of government, that you can do to survive this crisis and grow. And history has shown and proven the types of investment you need. There's a lot of investment that we talk about today that you could move. The 60-40 won't work anymore. And it's becoming very obvious. 6% stocks, 40% bonds. That won't work. Because and inflation is one hell of a situation to control. And if you don't, you should read the biography. Just do a Google search of Volcker and see what he had to do. The federal funds was raised to 20% to break the back of inflation. So it wasn't just no 0.5, a half a percent, half a point, 50% basis point. So this is what we have to face. We can all get through this through divine guidance and instructions, and also prayer and things that we can do collectively with individuals to help us through the situation. Thank you very much.
Thank you, Lee. I'm going to go down the roster here with a couple or three different questions that I want to get everybody's response to. The second question, so I'm going to give you a second to think about this, is I want each of you to tell me what your single best, most exciting, potentially productive theme is right now as we sit here. So mull on that. Doesn't necessarily have to be an individual stock or even a sector. It might be something totally unrelated to specific investing, but that's going to be question number 2. Question number 1 that we're going to start with, however, has to do with this past week. For the first time in 20 years, the Federal Reserve raised interest rates by more than 25 basis points. They raised rates by 50 basis points. And there was a mixed reaction to that. Immediately after the announcement Wednesday afternoon, the Dow Jones was up roughly 1,000 points. Yesterday gave it all back and a little bit more, and then a little bit more still today. And I mentioned this in my talk earlier today, both the dollar and the level of market interest rates got up to their highest levels each of the last 10 years. And the question is whether they're going to go much higher. But here's what I'm going to ask each of you, starting with you, Lyric, is were you surprised by the Fed's action today, this week? Did you think they should have been more aggressive, or do you think they're doing the right thing, and why?
Well, I think that nobody was surprised. Nobody in markets were surprised at all by this. They clearly communicated what was going to be happening. I think the turbulence that we're seeing now is because we're entering a new monetary regime, a new policy era, and there are a lot of uncertainties. So I think it will calm down, after people get used to this. But, we had a lower for longer, so long that this is, it does feel like a new era. What I worry about with the Fed is not what's going on in the US. In the US, we're doing really well if you compare us to any other place on earth. But what I worry about is the effect of the strong dollar that you just mentioned and higher interest rates on emerging market debt, which has ballooned to $100 trillion during COVID, which is equivalent to the world's GDP, global GDP for a year. And those countries, I'm worried, will have trouble paying back their dollar-denominated debt. So I think the Fed's actions here in the US will stabilize, but I think the impact globally could be tremendous and negative. And I think we'll see that there will be defaults, because if you're running an emerging market and you have a choice between repaying your debt or buying food and energy for your people, as a politician, which thing are you going to choose?
Very good point. And we mentioned that earlier today. You weren't here, obviously, but yeah, that's a big subject right now. And the dollar is right at the place where it's the highest it's been in 10 years. And if you get much more momentum to the upside, then the technicians jump in and it really becomes a washout. And then, as you said, a lot of the dominoes around the world could start falling. And you'll have basically debtor strikes, I think. We had that once upon a time for a short time. It was back in the early 80s, I think. Until everything
and
got
there's
straightened
no
out.
international mechanism to deal with this.
Yeah.
During COVID, there was a program for the poorest of the poor countries to get a stay on the debt that they were owed. But they didn't want to do it. Why didn't they want to do it? Because it would have put them in default with their Chinese loans automatically. So that's why they resisted it, even though it was quite difficult for them. So it's a much more complicated world than it was in the 1980s, Chris.
That's for sure. Connie, your thoughts on the Fed this week?
Well, nobody was surprised, because nobody's surprised at anything anymore, because you get 2 weeks of this is what we're going to do, so nobody's surprised. But to Lyric's point, people are saying, oh, it's going to be big jumps in the interest rates to keep inflation under control, and they're going on and on and on. And then I have somebody go, again, to Lyric's point, people aren't going to be able to pay their debt. So they can't do what everybody is expecting them to do, which is these incremental 50 basis point jumps or 75 basis point jumps. It's kind of a game. But when you look at the logic and you look at the backstory and you look at the underlying, that's going to tell you a little bit more than the talking heads on Bloomberg or CNBC. I almost called it CNBS. That's what my father used to call it.
Yes.
So look at the underlying stories, and that's part of it, is what's really going on, and it is definitely global. We don't want to bankrupt our other, our friends and colleagues and neighbors out there. So, take it all with a grain of salt.
Well, and don't forget too, and I'll inject a little bit here, the times in recent years when there has been the most pushback against the U.S. dollar's continued reign as the global reserve have been times like this, when the dollar's strength and the inability to easily service debt by other countries gets to be extreme. And then they're saying, wait a minute, how can we live under this kind of a regime? It's not easy. And it may well get worse before it gets better. Talk about the Fed telegraphing these things. We were having a conversation earlier, and I remember those days starting out in the business when Paul Volcker was the Fed chairman, and you didn't have this mental water torture, federal open mouth committee, as some people have called it in recent years, where one day this governor says this, tomorrow this bank president says this one says that. And so, as I said in the commentary the other day, by the time the Fed raised interest rates 50 basis points, everybody and their dog and the fleas on the dog knew that what was coming. There was no mystery, no surprise about it. In the old days, Paul Volcker, you get up in the morning and there's a little news flash that says, by the way, I just raised the discount rate and federal funds rate by 0.75% overnight. If you don't like it, drop dead, have a nice day.
Right.
And that's what happened. And today we got to be beaten to death with words before they do it. Bill, what are your thoughts?
Chris, I think I'll answer it in a little different way. I know we have to deal with how the system is and how the Fed's impact on the economy and what will they do next. But every time I talk about the Federal Reserve, and I do a lot on my podcast with people much smarter than me, I have a problem just with the fact that I don't even believe we should have a Federal Reserve. Going back to when I originally started investing in... When you start to realize why you need gold, you also, at least in my case, realize we shouldn't even have a Federal Reserve. So you have Ron Paul's book, End the Fed, and things like that influence your thinking. And you say, gold and silver are constitutional money. And when gold and silver is the method of transaction, the purchasing power is preserved and the people are in control, not a private central bank. And so I guess I'll conclude my commentary by saying that for the first time in the last decade since I've been seeing things, and you hear people talking collapse, and some of it is sensational to sell newsletters, but the dynamics that we're seeing, when you look at what happens post a war, and it seems to me that we're in the early stages of World War III, there's monetary resets that happen on the other side. Now, if the Fed can't control inflation, and the economy is going down, and there's this great stagflation that you talk about, that's going to create societal unrest. And if people lose their income, they lose everything they have, they can't feed their family, you get that, what Neil Howe talks about, fourth turning event, and you could see a turning over of the government, and perhaps the people would demand true money so that this wouldn't happen again. There are some nations after the 2008 collapse, like I believe in Iceland, where they punished the people that they felt were responsible for what happened economically to them. And under that scenario, I would hope that on the other side of this, maybe we don't even have a Federal Reserve.
I'm all for that. My seventh child is named Andrew Jackson Temple. And
Seriously?
seriously.
Seriously,
Seriously.
okay. I'm just asking the question.
Seriously.
Okay.
And the reason for that is that when his mother was pregnant with him and we were all sitting watching the TV, everybody knows that Charlton Heston and Yul Brynner were together in the Ten Commandments, which I referred to earlier today. But they also were together in a movie called The Buccaneer, which has not been watched nearly as much as the Ten Commandments. The Buccaneer was about Jean Lafitte and the Battle of New Orleans. And so Heston played Andrew Jackson, and Jean Lafitte was played by Yul Brynner, a great movie. And we were watching that and came to the conclusion, together with my own dislike of central banking, which is why Andy Jackson was always one of my heroes, learning the money system, that if it was a son, his name would be Andrew Jackson. So that's how much I don't like the central bank either. So, Rob, you want to weigh in on the Fed this week?
Yeah, as the owner of Gold Silver Pros, I'm definitely in line with Bill that I want to return to constitutional money and the fiat money. I think, the way that it was put into place while most of the legislatures was on Christmas vacation. It wasn't a majority vote in the U.S. legislature. It was put in a sneaky way. Anyway, I think we probably all know that story. I do agree with a return to constitutional money, but I think that the IMF has a different plan. And the plan that the IMF outlined in 2015 in a position paper you can read on their website is for central bank digital currencies and the abolition of any sort of paper or coin money, in addition to an abolition of the debt-based system. And a follow-up on April of 2019 on the IMF blog, they talked about ways in which they would implement the system. So what they want to do, and what the IMF and BIS have signed on to, and what 50 of the world's central banks have also agreed to, and this is public information, is that they want to launch central bank digital currencies and get rid of any sort of physical cash, whether it be the dollar bill or coinage, any of the monetary metals out of the system. And to do that, they're going to use negative interest rates in the banking system in order to implement control over monetary aggregate flows, which would replace the debt-based system that we have now. And so in the reset that Bill talked about, that will probably come about in the next few years as everything plays out, they're going to have to eliminate the debt system. And that's why, at this point, I characterize what the Fed is doing as sort of managing the sinking of the Titanic. They know it's going down. I think Powell understands that. I think Yellen understood it. I think Greenspan understood it and understands it now, according to his commentary. He knows what's coming. I think the central bankers know it's the end of the fiat system. I think all of the world's central bankers know that. And they're just trying to manage it until they can get us into the new system. And they're furiously putting the infrastructure in place for that new system to be there as an alternative. And so I think they're just trying to keep people from panicking, which is why, as Chris mentioned, you see all the jawboning now around Fed open market committee decisions in the press. And to that point, when I was ironing my clothes before I came down this afternoon to the conference, I was watching CNBC, and all of the rhetoric was around how the Fed should have done this. They should have done, 3/4 of a point. They should have done this. They should have done that. But the Fed is doing what it has to do to keep the system from collapsing now until they're ready to move into the next system. And that next system, it's out there, it's documented. So I hope that there is enough pushback on that system that we can get back to a metal monetary standard. I don't think that's what the central banks want, and so really it's going to be we the people versus the government in determining what comes about. But their plan is already in place, and I encourage everybody to go educate themselves on it. And if you'll send me an email, Robert at Gold Silver Pros, I'll send you all the information you need to know to read those position papers.
Thanks, Rob. Dr. Warren?
Well, I agree with the last two speakers. They are managing a situation that they know that they have another system coming in. Basically, modern money theory, which scares the hell out of me. The digital money is no more than a fiat system, a rearranging, twisting. They still will be able to print in unlimited amount of what? Money. It'll be digital, and it'll be pretty much hidden because that don't have to be revealed. They allocate the UBI, Universal Basic Income. I tell people, I said, you think they're going to give you $50,000 a year to live, and they gave $50,000 a year to every citizen? how long do you think the average price would go? See, the cost of living would go skyrocket. So we need another, what they're gonna give us is that system. There's no question about it. But the people have a choice, and the choice is their own. They don't have to cooperate with the system. And we do have constitutional money. It still exists. And that constitutional money is what? Junk silver. And as people move out to these cities and into decentralized locations, like you go out on the farm, you can't tell a farmer that raises beans, chickens, and et cetera, that he has to take this digital currency. See, and you come to him with a silver dollar, see, or whatever, dime quarter, silver eagle, his mind begins to wander and realize that he has what? Real money, and the government has no what? Control over it. See, if we had the money that we had prior to 1913, you don't have to worry about all these crazy wars and stuff that's coming up, and they give $33 billion to Ukraine. What the hell's going on? You know, you don't have the money. And one thing about a gold-based and silver system, if you don't have the money, you definitely can't be starting no wars. So definitely what will happen is people will resort, a number, I didn't say everybody, resort back to bartering and trading, because you have local currency, the ethical dollar already. You have local currencies that are already a currency in various cities. And what will happen once the digital system kick in, everybody says, that's the beast system. In Revelation, that's the beast system. And many people, I didn't say everybody, but they will withdraw. And the currency of choice for the patriots and for those of liberty will be that junk silver as a transactional money. Nobody wants to be caught up in the system of that. And that's primarily how people will survive. That's going to be it. Now, it may be underground, it may be black market. Remember, in communist Russia, the biggest part of the economy was black market. And people survive in that type of tyranny. So there's always a way, there's always a what? A way out, a blowback. See, that's Isaac Newton says the second law of motion. For every reaction, that's equal in what? Opposite reaction. And people will react, not most, but enough there to say, listen, we ain't part of this. Thank you very much.
So what everybody needs to do is go back and read Atlas Shrugged by Ayn Rand and know what's coming and what power we do wield over the system.
Absolutely.
I'd like
Atlas-
to bring up a historical point. I'd like to bring up a historical point because I'm
Sure.
writing a book about silver as a monetary standard in China in the interwar period. So I've really delved into that, but China was on the silver standard in the 1920s and 30s, and that proved to be their Achilles heel and decimated their economy. How did that happen? The way that that happened was the United States decided to sell all of its silver, or a huge amount of it, and flooded the market. So China then ended up with an incredible amount of inflation, and it weakened their economy tremendously, and I think put them on the path to becoming a communist country after the war. So just because your country is on a silver standard, another country that has silver could suddenly sell everything they have and devalue what you have. It's not so simple just for one country to, and China is a perfect example, of that. And in addition to the second point is, in addition to the Fed was founded in 1913, but the Treasury Department was founded in 1789 and has been around a lot longer. And their actions, for example, sanctions on Russia and so forth, have had equivalent or even greater effect on the future of money. And why do I say that? Because the sanctions mean that other countries who don't want to be under the threat of some kind of asset seizure by the United States for whatever reason are now going to go to a different and parallel financial system. So instead of SWIFT, they'll have CIFIS. And they'll be, we will, for the first time, have a double standard in terms of financial systems. And that's the both foreign policy is carried out by the State Department and sanctions that are enforced by the Treasury Department. So it's not just the Fed.
Well, good point. And we talked about that some today. And look, I've long since, for a long time, I've said that if indeed the dollar is going to go on to history's scrap heap and no longer be the world's reserve currency, I will rejoice, not because gold will go up and silver go up. You got to be careful what you wish for, because if we can't compel a lot of the rest of the world to continue supporting our dollars, that's when you can start breaking out the wheelbarrows. Then the business you'll want to be in, if you want to start a cottage industry, is have wheelbarrows with your favorite rock star, your sports team logo, whatever. You'll sell the daylights out of them because we're all going to need wheelbarrows if and when that day comes. But no, my attitude is that if the dollar ceases that, and we're seeing the beginnings of that with these boomeranging sanctions, for example, against Russia, and that's just one example, if we cannot use the dollar's role to flex our muscles around the world and cause all the trouble, the world will be a far safer place net, in my opinion, than it is today, because we won't have these people that are now responsible for the first time ever having $2 trillion this year globally of spending on military. That's the total, and of course the U.S. having by far the biggest share individually of that. So I talked earlier about what question 2, but I'm going to have a 1B that's going to be really, really fast before we get to question 2. So we'll do this really fast because that'll put another couple of questions in your minds, and then after the next question, we're going to open it up to some of yours. Give me a number, if you want to, where you believe the 10-year yield, the 10-year Treasury yield will peak before we have a tradable rally, if not the end of this rise in market interest rates. Lyric?
Oh, I'm not going to give you that number.
All right. You can pass. You can
But I
pass.
have to think about that a little more.
I'm going to go out on a limb and say that we're going to be between
What's
4 and
your
4.25%, and that's if we don't have China implode in the next year, and that's if the Fed rate hikes, and there will be several more, don't break something in the markets. The markets, I think, are liquid enough. We will get a move above that level I talked about today. We'll get to 4.25%, but then your long-term trade probably, again, could be going long treasuries because, in fact, Lyric and I were talking about this the other day. Japan has already flatlined near zero forever. The debt levels don't matter. Inflation doesn't matter. None of that matters. Europe has been Japanified more recently. They're dead in the water. Their banking system is toast. They've got to keep the printing presses running. Maybe to save face, they'll raise rates once or twice, but they're kind of flatlining too. Inevitably, I think we end up there as well. But I think between here and there's still enough inflation cooked in. There's still enough liquidity in the system that we'll go to 4 to 4.25%, and that'll probably be it. Any opinion, Connie?
Well, there was mention, as I was scrambling on the website, about the world becoming more siloed over time. And the reason that I bring that up is because if our yields go to 4.5%, 5%, I think that there's a potential to bring the good stuff, if you will, and being able to pay the debt from these emerging countries that are going to be struggling. So there could be a interesting dynamic where the emerging markets can pay their debt based on investing in our treasuries. So it's kind of a catch-22, I guess. Or, there could be some positive on a bigger scale if it goes a little higher.
Well, hope
But
so.
we'll see.
That's
We'll
interesting.
see. I would like my savings account to make a little bit more money. Even
Yeah.
if they do away with currency and they only go to silver, I would still like a savings account to earn a little more interest.
Bill, you got a number?
I'll defer on that question, but I'm ready to talk junior mining stocks in the future on this
All
panel.
right, we'll do that.
Okay.
Rob?
So there are a lot of analysts smarter than me in terms of interest rates. So I'll defer to one of them. I read a story, I want to say about 3 weeks ago, and I forget the analyst who wrote it, which computed somewhere around 3.25% is where he thought the debt markets would start to break if we got to that point. And that has to do with debt service levels. The amount of zombie companies we have, I do know that BIS put out a report probably 3 or 4 months ago that the world has more zombie companies than it's ever had, and their confidence index the BIS had for any of those recovering was at the lowest point in history since they've been measuring this dating back to 1960. So I really think it's not just the interest rates. I think it's a confidence game in the dollar, in particular being the world's reserve currency. It's almost a race to see is the bond market going to blow up first, or do people lose confidence in the dollar? And I think it's two sides of the same coin, because money is created through debt issuance. And it's just a matter of what is the catalyst. Is it the interest rates causing people to default on bonds across the corporate complex, credit card and consumer debt and sovereign debt? Or is it just that people stop wanting to use the dollar? We go to a multi-currency world, and all of a sudden we have to take a huge devaluation because the dollar is no longer accepted. And as Chris alluded to before, when it doesn't have the strength that it has, that could be a good thing in terms of our foreign policy, but it's a really bad thing in terms of the stability of the U.S. system.
True. Dr. Warren, you think the interest rates are at or near their peak, or going to go higher?
I think about 3 and a half.
Okay.
You have to be able to understand and get a narrative with the context. So we at about, 1%, 1.25 now. So you're talking about 3 times now, basically. Interest rate increasing 3 times. Now just think analytically and critically about this. Mortgage rates are over 5%. Right around 5, a little over 5%. Now you're talking about doubling the interest rate. What are we talking about? 7 or 8% mortgage? Do you know what that does to the real estate market? It crashes the hell out of it. And the real estate market is one of the largest parts of the economy. If that crashes, you can forget everything else. The overall, what the construction industry does for homes and the product and raw material it needs to build that's gone. Lumber, you name it. So, and we're not talking about people losing homes and foreclosures and all. You're talking about hell. You're talking about chaos in the street. That's something we can't even imagine. You think the stuff with 20, with the Biden and Trump thing, with all the BLM mess, that would be child's play, because people are talking about losing homes and the social chaos that would do now at about 8%. And then let us look at the national debt. What are you talking about? What if you ask the average American, what is the interest rate that America pays on the debt of the Treasury? They don't have a clue. It's right around $500 billion, a little over $6 or $7 trillion, I think it is. You're talking about going to 7, you're talking about going to 3%. Wait a minute, we're talking about, what are we talking about? Maybe approaching $1 trillion? Well, how much tax revenue do we collect? It's about I think it's about $4 or $5 trillion, 6. I think it's at 6. I don't remember. I can't remember. But I'm saying you can see the complex problems going to arise, and something will break in the bond market, housing market. You got one crazy, chaotic mess that the politicians, the wrath of the people, after this thing gets to a point of 3, 4%, whatever, I don't know what that number is, but it'd be hell to pay, because the people would actually finally wake up and realize that everything they worked for all their lives is gone. The Federal Reserve and the banks have it all. So those are the issues that they face.
I'd like to do a follow-up, if I can, to what he said about the housing market. So the number for the U.S. housing market is somewhere between 33 and 34 trillion. And that's a big issue. Like you mentioned, if that crashes, it takes the whole debt complex down in the U.S. But through foreign direct investment and the globalization of debt across the commercial banking sector, it'll also crash all the other banking systems around the world. And the bigger black swan is actually the Chinese market. I think it's 61 trillion.
Yeah, 61, it's about
61 trillion, and it's the biggest single asset class in the world. And so when Evergrande and all of those other 4 property developers started defaulting, it caused everybody to look at the Chinese housing market. And I think a lot of the foreign holders in Evergrande never got made whole. I think there was 20 trillion in foreign investment in Evergrande, and they only clawed back so far, I think, a couple of weeks ago, 20 billion, 2 billion. So they've only gotten 1/10 of the money back. And my question is, if that starts to occur more widespread across the world property debt markets, how long is it before you start seeing bank failures? And will there be a domino effect of a small commercial bank failing, leading to a bigger and a bigger and a bigger? And if so, how does the Fed and the world central banks actually control that? Can they with the current interest rate levels, and can they with the current policy tools? I don't think they can, but I'd like to hear somebody else's opinion on that.
Okay, now we're going to go back, that was 1A and 1B. So now we're going to go to what should have been question 2. And this is what I asked earlier. And so each of you, and again, it can be anything from an individual stock to a sector to a human interest theme to whatever. What is, if you can pick one, what is the most compelling, exciting, important, whatever theme to you right now? Lyric? Lyric, you're muted.
I think I'm going to be very unpopular in a moment because I would say cryptocurrencies. I think, and I know that there are a lot of gold bugs and silver bugs here, but I think, to me, there are 2 words why I'm worried about gold: Elon Musk. I mean, the reason I mean that is because there is going to be space exploration, a meteor, we're doing mining, we're going to find more supply. The supply is not limited. It's potentially almost unlimited. So that worries me in terms of value. So I would say cryptocurrencies that have a fixed supply, I think are something really, that's a theme that I think no one can avoid. And in this global world, which I described, where we'll have multiple systems. We'll have the US Western-based system. We'll have the global South, which will be China and other people. There'll have to be a layer in between those 2 systems to transfer value. And I think that layer will be cryptocurrencies.
Interesting, okay. We haven't talked much about cryptocurrencies yet. That's important. It's a big subject these days. Connie?
I have had a wonderful opportunity to partner with someone who is a generation younger than I am, and he's all about digital media. And he's bringing the digital media to the company, or digital expertise to the company, and I am bringing the human element to the company. What I've learned in working with this gentleman is that the generation below us has a very different mindset than we did. And if we all don't stay very open to what the generations coming up underneath us are focused on, talented at, care about, we're in trouble. We're just in trouble, and we're all going to get left behind. It doesn't matter if we're 55 or 106. We got to pay attention to these kids, because these kids are what is going to save the country and the housing market. And when I was their age, my interest rate on my home was 12%, and I'm still here. And I always believe, thank you, Dad, that humans will figure it out. There's a lot of smart people out there with a lot of good in their hearts and passion, and the human spirit is not containable. I don't care how hard you try and how much the government wants to change things, but it's all about that whole empowerment and growth and passion and innovation and disruptors. I love disruptors.
I love that.
I think we got to pay attention, guys, to what's happening all around us, not just in certain segments our society or our monetary system or the investment world. There's a great big world out there.
Yeah. Great answer. Bill?
I'm going to answer in the context of junior mining stocks, and we've heard from a lot of issuers today. And I cringed a couple times in a couple presentations, not because of the character or the presenter or even the investment value proposition that was being spoken of, but when the word BLM, Bureau of Land Management, was mentioned, we just need to get this from the BLM, or we just need the BLM to do this. Government risk and eliminating government risk in my junior mining stock portfolio has been a theme that I've been focusing on over the last few months, because in junior mining stocks, failure is the norm. And so I had a failed silver mine investment. I made money on the deal, but I was up tenfold at one point, and I think my exit point is like 150, 200% gain over a 2-year hold when I was up tenfold at one point because of management failure and some geological difficulties. But one of the reasons why I took a risk on this silver mine that was supposed to come into production is because they had their permit. But when I look over my portfolio and companies I work with, a silver explorer that I like with this very interesting silver project in Arizona, man, how long does it take to get an exploration permit in Arizona? 4 years? I don't know. It's taking forever. Or when you go for 5 years and you work with the governmental authorities like Trilogy Metals did in Alaska, and you go through a 5-year consultation process and you get a permit for a road, and then the government comes back to you and says, wait a second, we're going to look at this again, and they take that back from you. What are you to do with that? And so as a junior mining speculator, I've been looking at my entry point and my visualized exit point and saying, how much government risk is there? And do I think I can make money buying and selling this issuer and not having the government bring its foot down and say, you can't move forward with this permit or this project, or we're going to stall you or hassle you with what you're trying to accomplish?
Good points. Rob?
I think there are lots of positive things to look at. I think from an investment class perspective, I would say commodities. I think we're going to see a return to value investing, the Peter Lynch, Warren Buffett method. I think people are going to return to common everyday things. And I think the amount of demand we're going to have for commodities over the next 10 years is extraordinary. So as an asset class, I would say commodities. I would say from an aspect of what I see being very positive is the internet and the democratization of information, I think, is going to lead people to get more educated. And I think the people that will end up saving us and the technologies that will end up saving us echo previous thoughts. I do think decentralized finance, DeFi, some of the cryptos are really solutions that are kind of disturbing the world order, if you will. And I think the millennial generation probably has less vested in the current system than any generation. And I think they're going to blow it up. And I think that they're going to have alternatives that the government's probably not smart enough really to regulate and capture in a lot of ways. And so I believe the millennials are going to lead us out of this, to be honest with you. When I talk to them, and I go to events all the time talking with the younger generations, and I do this on purpose, they don't care about the current system because the current system in their eyes has screwed them. So they're like, why should I care? I'm going to develop an alternative. And I think they're forced to develop alternatives that are going to open up a lot of opportunity. And according to Kiplinger's, they're over the next 10 years going to inherit and or earn $63 trillion. So not only are they the largest generation that we've ever seen on planet Earth, but they're one of the smartest and they're going to be one of the wealthiest. So I think they're probably going to come up with most of the solutions to our current problems.
Great points. Dr.
Yeah,
Warren?
I'd like to kind of kick back a little on commodities demand coming up, because what has been the engine of growth for the world? It's been China. And we've just been talking about the real estate market there, the overbuilding that has been done. I think there's 2.1 apartments for every Chinese person at this point. They're used as investment vehicles and also as a way to trade favors for officials. So, if you look at it that way, not per person, but per household rather, is 2.1 is the number. So if I look at the UN census numbers and projections, and if the United States reaches its most optimistic projection, and China reaches its worst, the United States at the end of the century will have more people than China. China is slowing. China is not growing. The same thing with Japan. The same thing with Europe. Where's the growth going to come from? That's what I'd like to know, if commodities is the bet.
It's
And
going to come
energy,
from India,
at
the
it.
Middle East, and Africa, Africa being the largest continent on Earth, and I think India being one of the largest countries. I do agree with you on the overbuild of China, but if you look at the entire world as a whole, I think there's going to be tremendous demand for commodities. I would also add one point. I think we're going into the space age, and I think people are used to looking at economic models from an industrial age perspective. When we go to the space, it's going to be a completely different paradigm that I don't think anybody's really, or a lot of people aren't really looking at. Case in point, Nokia has a contract to build 5G internet on the moon, and I know this because I was involved in the 5G industry, and they're already building it. So they're building communications infrastructure on the moon. We're going to have space stations. India has put out more satellites over the last few years than all the other countries in the world have put out in their history combined. So I think the race for commodities is on as we move into the space age. And I think it's getting beyond looking at just conventional measures here on Earth. You have to look at what's coming in the next 20 to 30 years.
Cool. Lee, real quick, your main idea, important point, and then we're going to open it up to the crowd for their questions.
I think the most important concerning that is the last speaker point I dropped. You? Mm-hmm. Yeah, it's commodities. Commodities will play a very important part. Now, I like to say this. If you look at the history of this country, I'll say this, the way the educational system is piss poor, excuse the word. Put it this way, if you just study money, or you got a coin collection and understand all the coins and just follow the history, we have a turbulent history of money. I mean, it's very turbulent. Every year, every couple hundred, every 50, 60 years, money changes, One time we had the greenback, it was a whole situation. We had silver versus gold. My point is that that's always change is coming. Now we got a fad with crypto and the crypto stuff and digital. I'll say this, if the government goes stone digital, understanding the Federal Reserve in their policy, they don't like competition. That's the reason Gaddafi and Saddam are no longer here and that country was destroyed. The country has been so successful just recently with Russia because they had the nukes. Now I'm saying if they implement total digital money, I can guarantee you that Bitcoin and all these cryptos, they'll do the same thing they did in 1933. They'll outlaw and put all that into what? Into the digital money. They can't take the competition with Federal Reserve digital money. You got Bitcoin and all these other cryptos. They say, wait a minute, this ain't gonna work. I'm talking about the people that control it, the money makers, the masters. Some saying, those that have this great idea and thinking that they're going to implement this system that's going to undermine what's already that has ruled this system. I don't think so, and we'll just have to wait and see with that. But if the Federal Reserve or whatever, the U.S. Treasury, whatever which way they put it together, and said we're going digital, and everybody's going to accept digital money by the federal, that's money. Then what do we do with the cryptos? What do we do with Bitcoin? That's an interesting conversation. Do we have a rivalry here? We'll wait and see.
I want to throw one thing out in answer to that question myself real quick, and then Eric is going to be going around the room with a microphone, so make sure he sees you. If you want to pose a question, it could be to one of us, it could be to a couple, however you want to do it. But one of the subjects we talked about earlier was the untenability of current debt levels with the rising dollar, with interest rates going up and that type of thing. So for an investment theme that I've talked about numerous times, and I'll repeat it here tonight, ask yourself, what policy moves can the government make that enables the additional credit to come out to help pay off current bills, to drive economic growth and so forth? I, for one, have been astonished, and Trump was guilty of this, and Biden's guilty of this. And not that they could single-handedly do it. I cannot believe that with all the talk about this for years, that the U.S. does not have at least one major infrastructure bank, which I still think will come out of necessity. It will start as seeded with, quote, public money. Wall Street will get involved and securitize it, slice it, dice it, create zillions of dollars worth of securities. That will enable the extend and pretend of the fractional reserve system to go on and rebuild infrastructure and help reduce carbon and do all of these other things. So I think that's going to be a big theme going forward. It's been handled horribly by our, quote, leaders for a while, but that is coming. It's coming out of necessity. We may have to go through another bust in the markets first before they wake up to it. But as you're making your shopping list for investment ideas, and this, of course, will inevitably benefit commodities as part of this as well. Right. As you're making your shopping list, ask yourself, what policy things have to come to keep all of these funny money systems afloat, and what are the investment themes? So it's going to be an infrastructure, all the green energy stuff when they get their acts together and so forth. And of course, a big one that's already a play toy of some on Wall Street, hasn't had the best start, but the whole system of trading carbon credits, the ESG paper that's coming out. Those are going to be huge investment themes also. There's a lot of scams, especially in the ESG stuff right now. Everybody in here, again, the dog and the fleas on the dog, they all claim they're ESG friendly. Some are and some aren't. There's already been a lot of money raised. You know, you've got Wall Street has been, you know, browbeaten into not putting money in oil and gas companies anymore. So now these same institutions will buy ESG bonds. They don't even know what the heck they're buying. All they know is there's those three letters there, ESG. Okay? That's going to sort itself out. The wheat will be separated from the chaff, so to speak. So here again, another theme going forward that's, you know, one of my favorites. So,
Chris,
audience questions.
Chris,
Well, wait a
I'd like
minute.
to say something on that.
Wait a minute. Hold the audience
You're
questions.
being accosted here now, boss.
All right, I'm being accosted here. So Lee, quick, so we can get
Real
to the
quick,
audience.
this is real quick. Germany, when they had all the crazy money situation, you know what got them out? I think it was called rent money, or the rent market. It's based on real estate. That's what it came back to. That's what brought the stability back into the German market. You know, we had wheelbarrows, and they finally didn't have anything to base the money on. And it all of a sudden done, they said, what about all this real estate? And that is what brought the stability back to the currency. So it was real estate, basically, you know. Just look it up on Google. I forget what they called it. I thought it was Rent-A-Mark. Can't pronounce that, I can't remember, but it's something like that. And what Chris said about the bringing back the credits for infrastructure and construction and that type of thing, that's going to be successful because it's based on the same similar that the Germans did.
Okay, Connie, you had something?
So are you saying that the original idea for the municipal bond hasn't considered and been able to grow our infrastructure so they get bonds to build bridges? That system didn't work? Is that what you're saying? We need a whole freaking bank to make this work? The government can't make it work, so if we privatize it, maybe it will work.
Look, I'm not saying I agree that that is what should happen. I'm saying that that is what's likely to happen. The government, when it makes a mistake, always doubles down on that mistake.
Correct.
Ask Jerome
Correct.
Powell and his transitory nonsense
Right.
for so long, that he doubled down on the same mistake. So no,
Right.
for years, and some places did it better than others, right. That's why you had municipal bonds. Was for highways, for bridge construction, for
Right.
hospitals, for whatever.
Right.
And sometimes it works, sometimes it doesn't. Sometimes somebody got in over their head. We won't mention any names, but we happen to be in one of those states. If there's a question about that.
No, come on. Come on.
But then things don't work, and then they just start these so-called general obligation bonds, which means just give us more money because we don't know what
'Cause
we're
we
doing.
don't know what we're doing with it, right?
But give it to us because we need it.
Yeah.
So,
Go. There's a
anyways.
reason that it's go, right?
all right, questions from Eric?
Okay, good evening, everyone. I actually have a couple of questions. One, the Biden administration has put out some information about student loan forgiveness, and there's certain qualifications for that. Do you think that this could be possibly the beginning of maybe a jubilee, such as a reset, to just start everything over, and for future of the economy, they just reset everything and just forgive everybody's debt? That's my first question. My second question is, how does the panel feel about NFTs being the next big thing?
All right, the first question, Jim Uriel, who couldn't be here tonight, he's a financial commentator. Many of you have seen him on Fox, on CNBC, and so forth. He made a statement on his Twitter account the other day that I agree with. He's torn because a lot of these students that have these unpayable student loans were hoodwinked by lenders, by schools who preyed on these people, okay? Now, does that mean it's right to forgive their debt when they don't forgive somebody else's? No, which is why, in addition, as Connie mentioned earlier, to reading Atlas Shrugged, I would also urge you to go to the Bible and read the book of Nehemiah, because that's the wake-up call that we need as a society, and it also carries the solution. And the solution is a debt jubilee. This is all unsustainable. Everybody knows it. And, you know, of all of the brilliant economists that we've had in the world, you still can't beat our Heavenly Father, who had sense enough and knew enough about mathematics to know that you cannot have open-ended perpetual debt on top of debt, which can never be repaid. And when you had that system of a sabbatical year every 7 years and then a jubilee year every 50 years, that was a great governor on the market, on the private market, because you thought about, if you're one of those lenders today that lends money to zillions of students, I mean, they can't even read and write, and they're going to college, okay, in our society today, a lot of them.
Easy text.
All right?
Easy text.
In that system, where you knew that the debt had to be good and it had to be short-term or it was going to be canceled or forgiven, you'd think twice about who and what you're loaning money to. So that's my answer. Who else wants to weigh in on the student debt one?
Well, it sounds very polarized to me, because we've got, you know, do we forgive the debt because these kids are coming out of college and they're sunk, right? It's going to take them 30 years to get out of debt. And then on the other hand, we've got the largest wealth transfer ever about to take place. So which is it? You know, which theory are we going to go with, and which problem are we going to solve? It can't be both, because both doesn't work.
No, I mean, maybe the Democrat Party and Joe Biden are running out of people, and the Chicago cemeteries need a few extra, you know, they need a cushion of some more votes, you know, for the fall. I don't know.
Right, the living and the dead. That's the welcome to Illinois.
But anyway, it is a very polarized issue, and it's intended to be, folks. Think about that. Like everything else in society, the powers that be that got all of us into this mess over a lot of years, they've got to pit, you know, groups of us against other groups of us. It's never them. It's just like inflation, like that Joliet J cartoon I shared earlier this afternoon. Inflation's everybody's fault except Jerome Powell's. So anyway, now the second question, NFTs. I'm an idiot when it comes to those things. I could be non-fungible token. Is that what that stands for?
Yeah, I'll take a stab at that one.
All right.
So recently I have a friend who's a C-level exec at IBM who does a lot of digital inclusion, that type of work for IBM, and has a lot of events. And I went to Miami recently, and I talked to a lot of people who are developing NFT solutions, crypto solutions, and a lot of young people in that space. The NFT is a way at its core to provide value to something. So you take a piece of artwork, you put an NFT on top of it, and it's like a what do you call it?
Tokenized ownership.
Yeah, tokenized ownership is basically a chain of title is the phrase I was trying to use. So through the digital system, you can tie that to anything. And one of the projects one of the people was working on was NFTing a commercial building so that people who wanted to either rent space or use that commercial building could invest in the NFTs for it. That's a way to get investment in. But then it concreted along with smart contracts, concreted their rights in a digital way, so that it kind of revolutionized the commercial space. Things went a lot faster in terms of setting up leases, agreements, and those types of things, and it also emphasized property rights in a more concrete way. So NFTs have a lot of potential uses. I think it's going to have tremendous value going forward. However, in terms of the way a lot of people play NFTs is they'll develop like an image and they'll NFT it, and then the image doesn't sell, there's no value. So I think from the perspective of there has to be underlying value. Just because you're NFTing something, like if I NFT my name tag here, how much do you guys want to give me for it? I'll take bids starting at $100, right? Just because I have the original NFT, if that's not value in and of itself. Whatever the NFT is put on has to have intrinsic value. But NFT could be a tremendous mechanism for property ownership, faster contracts, commercialization, efficiencies in the economy, especially with related to the property sector, which is, most of our property laws date back a couple of hundred years, and they're very antiquated. I know from doing real estate for 20 years. It's just such a slow process. So doing NFT in like the title space, using a smart contract could be huge in terms of efficiency in the economy, cutting costs and things like that. So I do think that there's a lot of opportunities for NFTs.
But Rob, wouldn't you want to see more years of legal precedent and maybe court cases disputing ownership before you would take a big stab at investing in something with the tokenized ownership inherent in an NFT?
Yeah, I do think it's kind of like the chicken the egg argument. Do we establish that law or do we establish a technology? I think it goes hand in hand, because some of those questions will be answered as something happens, and then you'll build your law around it, because we work on the common law precedent system. So I think we could establish more around the legal scope of supporting that, but I think some of it's going to come about as a result of these interactions in this space, and as people figure stuff out and say, oh wait, we need a law for this, but it's going to be based upon a trial case, which establishes, okay, what are the concerns in this specific instance? And I think specifically with NFTs, it's going to be so wide-ranging that I think it's going to go across existing legal precedent, but it's also going to provide us more case law and more new precedent that we haven't had before.
Interesting, more innovation. Yes?
Getting back to student debt, it's my understanding some of the debt is issued by private banks and some of it by the government. Now, from what I understand, it was the bankers that convinced the politicians to prohibit the discharge of student loan debt if a student files for personal bankruptcy. Mm-hmm. In other words, discharge all your other debt, but you can't touch your student debt. It still stands. So for that portion of debt, student debt issued by private banks, I would make it dischargeable in bankruptcy. Not totally, but perhaps 50% discharged, and let the private banks that bribed the politicians originally to suffer the consequences, and let the student pay off the remaining 50%, as an example, over a period of time at maybe a decent rate, not an outrageous rate. And insofar as the student debt that has been guaranteed or issued by the government, I have no solution, no suggestion for that, because whatever you do, you're going to be damned by one side or the other. And my comment, I will also agree with Professor Jill about crypto. When the government implements its nationalized crypto, everybody else is going to be wiped out. Remember one thing, politicians are addicted to power.
That's right.
They are not going to allow some private crypto to take the monetary power away from them, and eventually they will outlaw it, just like they outlawed gold ownership in 33. Thank you.
Yeah, and the U.S. government, to your point, has already basically laid out their plan. The CFTC is going to regulate the derivatives around Bitcoin and other cryptos. The exchanges, like Bitfinex and all of those, will be regulated as banks under the SEC. And so, yeah, I think that's going to happen in the U.S. They're not going to I don't know if they're outlaw it. I think they're going to try to control it through existing law, which will basically have the same effect. Yeah, it'll cause Bitcoin and others potentially to plummet in value.
That's right.
In relation to CBDCs.
Does anybody remember when Facebook first announced, and I can't think of the name of it right now, if somebody knows, help me out. They announced that they were going to have their own, quote, cryptocurrency that would be used through Messenger. What was the name of that?
I forget the name. I just call it Facebook coin.
Facebook, whatever it was. And this was like 3 years or so ago, I want to say. Everybody in Washington was hysterical
right.
over this, okay? They have not been nearly as hysterical over Bitcoin and Ethereum and all the rest of it, which tragically, in my view, are nothing but glorified games of musical chairs so far. I hope it turns into something more than that. And here's my point on that whole thing, and to yours, sir. What have we gained, if you're looking at this from a libertarian free market standpoint? What have we gained if Ethereum is here to stay, if Bitcoin is here to stay, and the rest, when it's still the same dollar being used underneath it, still the same system? Anything you make has to be taxed in dollars when you file your tax return, et cetera. You've really solved nothing. In fact, I would ask, instead of converting things into Bitcoin and back, you already have a debit card in your pocket. You've already got other means to instantly digitally transfer money without even getting involved in cryptocurrencies. So to me, the promise of the cryptocurrencies was that they were going to be an end run around a system, a truly independent new form of money. And they have not become that yet. And the closest thing to that was this thing that Facebook suggested, because now all the hoi polloi can use this. And it drove them nuts for a while. They had hearings and this and that got pushed back.
Well, you're looking at this from the viewpoint of the United States and its extremely developed system of payments.
Okay.
But have you ever tried to send money overseas using your bank? And especially if you send any large amounts overseas or are expecting to receive them, they get lost in space. And in some cases, you can't even send, they're not allowed to send them. So I think that what we're talking about, or what I'm thinking of, is as an international currency.
Okay.
Not something you're going to use to buy a Coke, but something that you would use to, and also in places where, and in countries where so many people are unbanked, it really is it's a means for people who have a mobile phone to suddenly be able to receive and send money, and not using Western Union and those high rates. So going back to student loans, let's look at the moral hazard aspect of that. The private banks then who take these haircuts, who is going to then offer student loans ever again? You're effectively going to nationalize the student loan market. Only the government will do it. But I think the real way to attack it is by looking at interest rates. The interest rates that are charged by credit cards and student loans are far above the interest rates that banks can charge. They can charge, is the maximum 29.99%? The people who get in trouble with their loans and with their credit cards almost always has to do with the interest rates. And the credit card companies, and they accrue and accrue and accrue, and suddenly a $10,000 loan becomes $50,000. So if you change the laws about that, and the credit card companies will say, oh, well then we're doing that because the risk we take. Well, then they shouldn't take risks. Then those people would be better served by not getting credit, because they're not going to be able to pay it back. So that's my view on that. And credit card debt and student debt are crippling. And if you can imagine, if in the future that didn't exist, what an impact that would be on the housing market, which is already hot. So another answer to the question, which about a theme. Housing is in very short supply in this country
Yeah, true.
and will be for decades.
What do you think the probability of the government reducing interest rates on credit cards will be?
Well, the question is, what are the chances the government will reduce credit card interest rates? They regulate interest rates, but within a very, very wide band, and the existing law allows these usurious rates on credit cards and on student debt and all the rest of that kind of stuff. But I think one of the things that we probably all agree on, and I'll use Obamacare as an example of this too. They did the same thing with Obamacare, same thing with student loans. When the banks don't want to they're all about the free market. Insurance companies are all about the free market. Unless they can get politicians to take the free market off their back and basically guarantee their winnings and put the obligation on the shoulders of the public debt / taxpayers long term and not have to deal with it themselves. The insurance industries had a huge windfall from Obamacare because now they don't lose anything. The government is the one that's going to lose anything if somebody's going to lose. Eric, any other? Oh, George.
The connection of Russia, the ruble, and his demand for rubles for his gas, and now his connection to gold and other commodities is somehow connected to the rest of the world, right? How is that going to play out? If he connects, you have to buy his oil with the ruble, and now he's connecting the ruble to gold, isn't his currency connected to everybody else's? How does that play out?
Anybody want to get there? You want me to-
Yeah, I'll take that one.
Rob?
So, just my viewpoint on it, and there are a lot of wide-ranging viewpoints, so please do your own research on this one. But I believe that the trade for natural gas and rubles was to stabilize the ruble, which was crashing at the time. It forced demand on rubles. But at the same time, they needed a governor for that because the ruble not being the reserve currency is more susceptible to like a large inflation event than, say, the dollar. So in order to put a governor on it, they said, we're going to buy gold at a specific amount of rubles per gram. And what that allowed them to do was through that trade regulate how high the ruble went. So it's not a floor on the price of gold and rubles, it's actually a ceiling. And by using gold as a way to regulate their currency, and a recurring theme throughout history is use gold, right? When everything else fails, use gold. Currencies get not necessarily pegged to, but they get regulated by natural money, which is gold. That's what Russia's doing. So they did the natural gas trade to support the ruble so it didn't crash, so they could support their society. But they used gold, and they can trade as much or little as they want, as a governor on how high that ruble went. Because in a currency, you need to keep it within a range. You don't want to get too valuable or not valuable enough because it affects your current account balance in your trade, and your ability to finance your economy. So that's kind of my viewpoint on it, but I think it's yet to be seen as to how that actually turns out, because I think it's a pretty young set of policies that Russia has enacted.
I had a lot of excited emails and inquiries when it first came out that Russia was allegedly tying the ruble to a certain number of grams of gold. Mm-hmm. And one of the people that asked me, well, how come gold didn't go up on the news? Mm-hmm. That's not the point. And you explained that somewhat, Rob. The point to me, and I do think there's some significance to the fact that the physical stores of gold, we all know this, have been moving from west to east for a long time. Mm-hmm. Because these other countries know that in the unfolding new order of things, where we have a multipolar world, it's going to be a whole lot better for them to have gold as an anchor, since the West has decided it's a barbarous relic and don't want it anymore. Mm-hmm. But the bigger thing, I think, beyond that is the fact that Russia can start to command the terms to be paid in its resources. This is not about gold. This is about natural gas. It's about oil. It's about uranium. It's about all of these things. They hold a lot. Mm-hmm. And so I do believe that part of this multipolar world to come is going to be countries like Russia, like Indonesia, even if they ever had, a halfway sensible and competent government, and some others that still have huge stores of the resources the world still needs, maybe in a different mix as the world goes more green and tries to reduce carbon in years to come. But that's where their strength is going to be. And again, this country, in the sanctions regimen and being a big cause of this whole thing in the first place in Ukraine, we have greatly accelerated the coming greater economic power of Russia, of India, of these other countries. Connie?
Well, I think that there's something that we talk a lot about the Band-Aids and, you know, the solution for this and the solution for that. What I think people tend to forget with Russia and all of its power, with all of its energy, is that all of the big boys in the United States who went over there to say, this is how you drill a well, this is how you put this together, this is how you move product from point A to point B through these pipelines and monitor that to make sure it works. Well, guess what? They all came home. So there's a bigger picture there with just Russia's is using its energy to manipulate the chessboard. They're scared. They don't want to tell anybody that, but everybody that kept their energy moving and their energy supply going to where it needed to go, they're gone. These guys are going, well, how are we going to do this in 5 years? Because we ran out of people to make sure that it all works. The minute that system and that infrastructure starts to break down, guess what? Game over, folks. That's not going to be their play. It's all sitting in the ground. Oh, yay! Then it's sitting in the ground. But you got to get it from point A to point B to make it work, and all the people that made it work are not there because we said you have to come home.
True.
So don't forget that piece of it.
Okay, next.
Could you elaborate on your question 1B? I don't know if I caught all of that. How did you arrive at your number, 4.25, and what's the significance of hitting that number?
It's my target 4 to 4.25% or so for the 10-year Treasury. Somebody asked me. Actually, we talked about this, I think, when we were eating next door. Somebody asked where I thought the Dow was going to end up. I don't know. I don't know what the bottom is going to be for the stock market, but I do believe I understand the factors that have led to this at least cyclical bear market that we're in. Those factors are still in place. Ergo, the stock market will continue to go down until those factors have sufficiently changed to make me think that we're at the end. So I believe that for the foreseeable future, the dynamics that have caused long-term interest rates to go up are still there. Inflation is not going to come down right away. We are not going to see liquidity dry up in the market right away. Contrary to a couple of comments, I'll push back a little bit on real estate. Whether it's Wisconsin, where I used to live, and I got a call a week ago from a very dear friend who I thought I was going to stay with for part of the summer up there to give my kids a break, but he calls me to tell me that the family farm, 30-some acres outside this little town of Spooner, he had it listed for less than 24 hours. Got his asking price, which was pretty hefty, and he's moving to Florida. Watch when I'm going to bring my boat over and take him fishing, because he's going to be the other side of Orlando. So it'll be a little bit of a haul, but that's all right. And I don't have to tell you in Florida how fast stuff moves. So there's still lots of liquidity out there. There is still a lot of room for the narrative to continue to develop based on these current factors, that inflation is going to remain chronically high for a while, that the economy still has got some decent growth to it, and so I do believe we're going to see interest rates move up a bit more. My picking that 4 to 4.25% number is that I think that mathematically as well as time-wise, that's going to pretty well be the end of it. Even if inflation didn't come down, we can't see interest rates go up above the inflation rate like it used to once upon a time. It used to be when the Fed wanted to slow down the economy, if inflation's 8 or 9% right now, they'll raise the federal funds rate to 12.
Right.
All right, and get a few percent ahead of it. You'll have positive real interest rates. All of us in this room, barring a bust, when everything crashes for a while again, if it does, like 2008, before they inflate it all again, if they can keep this thing together, plodding along, some of us, we may not live to ever see positive interest rates again, real interest rates. the interest rate level will remain below the rate of inflation. But I do believe there is that extra room for interest rates to move nominally higher. But we've definitely seen the majority of the move. I mean, we started at 0.5%, give or take, for the 10-year Treasury. Today was 3.12 at the close on a 10-year Treasury. So proportionally, if we do go to 4 or 4.25%, the majority of the move is already in. And I would personally be salivating when we get to that point, if I'm right and we do, to think, okay, when do you start buying calls on TLT? You know, the long Treasury ETF, because that'll be a glorious trade again at some point.
And when does Social Security run out of money? And when does defense run out of money if they keep jacking these interest rates up?
They'll just keep printing more, and that's why I was saying earlier.
Helicopter Ben has come back? Is that what's happened
No,
here?
well, earlier today I showed the cartoon. I mean, we already graduated from Helicopter Ben to Cargo Plane J. Cargo Plane J was introduced, and he was shoveling hundreds of billions of dollars in one fell swoop into the repo market.
Right.
So after cargo planes, what comes? That great big mothership from Independence Day? They'll use that and
there
shower
you
us
go.
with money.
There you go.
Okay?
I like that.
So the one thing, unfortunately, which is why we shouldn't have a Fed, the one thing, unfortunately, that there is no limit to is their ability to print money, and they'll monetize the debt. You know, when Powell claims that, well, because the $9 trillion balance sheet is not intended to be permanent, well, no, we're not really monetizing the debt. All right, okay, tell us another one.
Right.
All right, it's just silly. And don't underestimate how far they can go. I've said this example before. I'll do this real quick. I remember, again, at the beginning of my career, there was a guy named Harry Figge. Harry Figge was the chairman of Figge International, a Fortune 500 company. He was one of the members of the President's Private Sector Survey on Cost Control, otherwise known as the Grace Commission, named for J. Peter Grace, who was the head of it. And this was Ronald Reagan's effort when he was elected to put together this blue ribbon panel of economists and corporate leaders and so forth, figure out how to rein in the federal government's budget. Harry Figge was so alarmed by what he saw that with his money and with his company's money, he was buying full-page ads in the Wall Street Journal and elsewhere. His annual report for the company for a number of years would update our fiscal mess as a country. Now, this, folks, was at a time when the national debt was reaching its first $1 trillion. Not 30 like we are today, but 1. Interest rates were high, inflation was high, we had the credit crises and everything in Central and South America, all right? And he was one of many smart people back then who said the U.S., on its current path, was going to end up like Brazil and Argentina and Bolivia and all those so-called banana republics back then. Now, if you and I had been sitting back, you know, having a cup of coffee or a cocktail, whatever, back then, and I would have said to you, Harry Figge's full of, you know, he's wearing a tinfoil hat, he's one of these conspiracy theorists, no, the dollar's not going to crash, no, this debt's not going to hurt us. As a matter of fact, I'll bet you that in a generation we'll go from $1 trillion debt to $30 trillion in debt. Yet inflation, at least until the recent past now, will be a fraction of what it was back then. Interest rates will be next to nothing, and the whole world will be fighting over putting money in U.S. debt. Rather than crashing, the stock market would also go up to like 35,000 on the Dow, and we'll all still be here. You would have quick picked up the phone, called Happy Acres, told them, send a rubber truck for this guy. But you know what? Here we are. And I'll tell you the same thing today, all else being equal, that a generation from now, we might have $100 trillion in debt. The Dow Jones average will be 100,000. But that Dow Jones average at 100,000 will not buy you in goods and services what the Dow Jones average at 33,000 or whatever it closed at today will buy. Any more than when you go back to that 40 years ago, the average American's living standard was better with the Dow at 1,000 when we hadn't played all of this modern money mechanics since then. So, Eric, where did it go?
Chris, since you're talking about interest
Oh,
rates,
okay.
yeah, I was going to ask another question. I'll come back to that. Since you're talking about interest rates and the 10-year bond. I think the last time we were here, if I'm not mistaken, you thought that you said you wouldn't be surprised to see the 30-year bond trade down to 1%. So I'm assuming that's off the table for now at least, but you think that could become a reality in the next 5 years at least, let's say? Or?
Well, you missed a discussion earlier today where I said
Okay, yeah, I was
my
late.
views had modified quite a bit from a year ago because inflation is running so hot and there is still so much liquidity and whatnot. So yes, we still are going to go higher for a while. But getting back to what I said a minute ago, there will come a point where things are unsustainable on their present course. And no matter what the current inflation rate is at that time, it might be modestly lower than right now, the Fed will again be forced by something to run up that white flag.
Right.
You know, and I think that's one of the reasons why, even though some people are saying, well, the Fed chickened out, they should have raised 75 basis points. No, as much as they can do in the context of the leveraged on top of leveraged on top of leveraged world they've given us, it's aggressive to them to go to 50 basis point hikes and try and do it in 2 or 3 or 4 meetings and hope that doesn't break something. And then they'll have the excuse by mid to late summer to sit back for a while. We don't want to influence the election.
Right.
Okay? Inflation is slowing down on its own. See, we told you. I was right. I mean, Jerome Powell hasn't been right about a whole lot of anything except, as I said earlier today, when he first took that job, to point out that it was the Fed's fault that we had the last 2 busts that we did. So what does he do? He repeats the mistake squared. Okay?
So maybe that's why the...
So we will get to a point again, and it may be a bust. It may be just like Wile E. Coyote off the cliff. The Acme rocket booster on his back just runs out of fuel, and there's nothing but air underneath. But it's not going to shock me if ultimately we do get back down to Europe and Japan-like interest rates. How we're going to get there, I don't know, but I am quite confident. Might be 2 years, 3 years, 5 years, I don't know. But we will get back there.
So that's possibly one reason the markets are not even lower in anticipation of the Fed retreating maybe by the end of the year or something. My real question, and I'd appreciate a comment on what do the panelists think that this current inflationary spiral, how is it going to affect the earnings of the producing precious metals companies? Maybe it affects the exploration companies as well, because money is one side of every transaction. So, and that's already being reflected adversely in some of the recent earnings reports, and I'd appreciate that.
Okay.
So a recent report came out, and mining CEOs now say their number one concern is actually ESG, which is one of the themes that have been in having to deal with that both from the government and the investor side. And I would have thought it was CapEx, capital expenditures in order to run mines, advance projects, bring mines into production. That's number 2. But I've talked to a lot of junior mining CEOs that are trying to bring mines into production. So one CEO I talked to in Papua New Guinea, he had 140 million or something like that in the bank between actual cash and a debt facility. And he wasn't responding to my emails, and I'm like, what's going on? And then I saw the press release. Yeah, we're not going to proceed anymore because the cost structures were completely blown out. Steel 2-3 times more than we thought. Labor, if you can even get people, are double. Wood, lumber for the mines 3 times. So it's really hard in this inflationary environment to plan a mine, because a lot of times the feasibility studies that are done to bring a mine into production, those could be 2-3 years old by the time you actually start purchasing the equipment to bring the mine into production. I referenced a silver mine that I invest in, and this is in Colorado, and again, the feasibility study that they were working at, that was pre this inflationary environment, and it was pre-COVID. And so COVID absolutely destroyed them, because when they would get one of the workers get COVID, you have to shut down the mine, you got to send everybody home, and you got to pay them while they're sitting home. So that eats up your capital pretty quickly. And then they didn't meet any of the cost expectations. Thus, they raised more money than they told the market, which the market didn't like. And then they couldn't bring the mine fully into production with that money, which the market really hated. So it's really tough to be a development CEO right now in the industry.
Can I add one thing to that?
Yeah, sure, Rob.
One of the reasons I'm bullish on commodities is because of inflation. Right now, the spot prices for all commodities is determined by derivatives futures contracts, not necessarily by the physical trade. And this is particularly true when it comes to the precious metals, who have the highest amount of derivative trades per amount produced every year of any of the commodities. I would say it's silver, gold, platinum, and palladium have 4 of the highest leveraged derivative trades. The problem with the derivatives trading is people are using imperfect information to set their price targets on the derivatives trades. When inflation becomes more and more apparent in the system, it's going to force people to go higher prices. So I do think that's going to be one of the things that drives higher market prices for some of the commodities, for the exact reason that Bill mentioned. If you've got a 2-year-old feasibility study and you can produce it, you profit at $14.50 gold, but then your costs go up 30%, now you need $2,000 gold, and the miners stop doing it, what will happen is the miners will shut down the mines, as he mentioned, and you won't have available commodities, and it will force the prices up in the futures market. The futures guys will get that information that say, oh, the prices need to go up, now we're going long, and the prices will eventually be dragged up in reaction to that. And on one of my blog posts I did a couple of years ago, I was looking at what was the biggest determinant of the gold price over long periods of time. The biggest determinant is the cost of producing gold for the 2 largest companies, Barrick and what are, you know, there've been a bunch of mergers, but the 2 largest gold companies, plus a percentage, what I call the fear factor of how much people are looking at, do we need to invest in gold? As it was variable, but it never went below the cost to produce an ounce for the 2 biggest companies. So the moment that the 2 biggest companies start having problems producing gold at current costs and they start to shut down, that price must move. And it always has in history.
Okay. We got time for one
one
more
thing is-
question
is-
before we wrap up. I'm hearing a voice from somewhere.
I have 2 questions. The first question was for Mrs. Hale. She said that she believed there would be a shortage in housing supply in the U.S. for decades, and I wanted to know what her basis for that was.
Right.
What is the
And-
basis for that?
Yeah.
Yeah.
Okay, do you hear the
Can I
lyric?
answer that one first then? Yeah, the American Enterprise Institute, AEI, there is an analyst there, Ed Pinto, and you can sign up for his information. He runs a whole group that does nothing but study housing prices. And he believes this year they'll go up 10%. And I said, well, what about, you know, these industrial buildings, you know, that people aren't going to offices anymore. Could those be transformed into residences? And he said they weren't built to have a lot of windows. They have a lot of internal space. So it's not a simple thing to convert those. And I said, well, what about BlackRock and buying up all the housing and so forth? And what if they suddenly dumped everything that they own? He said they're just not a significant factor, and they're buying it to sell it anyway. They're churning it. So he said they're just what happened in 2008 scared a lot of people, including my brother, actually, who was a builder. They're never going to go back into that business again. It was just too scary what happened. And then the rising price of lumber and everything else that we all know about. There just isn't enough new building going up to meet demand.
Answer the question?
Yeah, that's kind of a byproduct, perhaps, of when the Frank Dodd bill passed. It limited the community banks from creating ADC loans.
Exactly.
Yeah.
Yeah.
So I just wanted to
Yeah.
add to that and see what you had to say.
That's a good point.
That the
Great
ADC,
point.
ADC loans are loans given to developers to buy land and then parcel it into a neighborhood. So I just wanted.
That guys,
Yeah.
right? Yeah, they can't get the money anymore. Very, very good point.
Oh, okay, thank you.
Yeah, and that since they can't get that, that's contributed to this shortage. It's contributed to higher prices for existing housing, and it really, I think, and I guess I want to. This is a good segue, Ramsey. Thank you. I want to segue into a closing question for all of us. I made the comment previously that what we're facing when you look at the huge levels of debt, interest rates going up and so forth, you wonder at what point, whether it's builders, consumers, travelers, whoever, just starts to say uncle. and yet there are so many built-in things that continue to push the price levels higher. Shortages, the fallout from the Fed policy and everything. So it's like, how are we going to resolve this issue of, you've heard what happens when an irresistible force meets an immovable object? What is going to give first? We cannot have forever this open-ended rise in prices because at some point the market can't bear it. We have shortages though, especially for a lot of key commodities. They're going to keep prices elevated even if we have a downturn, mostly for oil and gas, I think. I mean, we're up at these prices to stay for quite some time. So what gives first? I mean, does economic activity get hit? Does everybody's wages go up 20% a year all of a sudden? I mean, how does this get resolved? I'm going to work backwards and start with Dr. Warren.
Well, if you want to look at it, by scriptorial, if you want to get into Revelations, it said Babylon and the mystery of the system would collapse. And that's basically what's going to happen. You get all the variables, if you look at them. Anytime you have these many problems in a system, it's just like a forest that has a whole lot of shrubbery. All of a sudden you have a lightning strike, and what happens? It burns the whole thing down. But in that creates a new what? New birth, a phoenix that comes out of it. You got so much damn debt, malfeasing the debt is, what are you going to do with it? And usually what happens in history, it collapses. But out of that becomes a new, stronger type system, or new birth, new order, whichever you want to say, that gets rid of, the biggest problem is debt. It impedes the growth of the economy at some point, because what happens? Large parts of interest payments, what you call discretionary income or whatever, those types of things hinder growth at some point. You just can't keep building debt on top of debt and not expecting something to happen, or as I say, pain to come to rid us of that type problem. But in that, there's a great rejoicing because we have a new order and things will be reformulated. Because let me say this, the financial system is out of whack. It's out of whack, and it needs some type of reorder. Wall Street, it turned the whole thing into a gambling casino and creates a whole lot of products and things that shouldn't be here, but that's the way things went into the Depression of 1930. So we need a collapse, basically.
So we really can't resolve those two opposing things without a wholesale upheaval in the financial system.
That's
and kind of
correct.
have to start from scratch at least.
That's
All right. Rob, what do you think?
So I agree largely with what he said. I think it has to be a reset, and I think that's why the World Economic Forum has reset all over their front page. And I think that's why the world leaders are talking about reset. You've had Biden talk about a reset. You've had bankers talk about a reset. Everybody's talking about a reset. The system's gone beyond the point at which any policy that the Fed can have or the government can have can solve it by itself. And not only we're going through a reset, we're going through a monetary regime change, I think, as Larry could mention at the beginning. And through that change, there's going to be a new system. The only question I have is how are they going to moderate the pain of the people going through that new system? Because usually when new systems come about, it does cause quite a bit of pain. I mean, just look at monetary history. And so that's why I always urge people to get outside the system as much as you can. I'm not your financial advisor, but just looking at history. And I think gold, according to Basel III rules, is going to be a part of that revaluation. But I think gold and silver are a way for you to kind of stay outside that system. But I will also say just be careful how much money you have in the existing system. Be careful how much money you keep in your bank account. Don't take on too much debt. Make yourself financially solvent so that whatever you're going through in that system, you can come out the other side. Just be smart financially with what you do. I mean, you're not going to avoid all the pain, but you can limit the amount of risk that you have just by making wise decisions. Even if you take like a David Ramsey approach and just get out of debt, that's probably the best thing, honestly, to do. If you're over-levered and that system resets, you're going to feel more pain than if you've reduced your leverage.
Okay, Bill?
If I would stick between the binary choice that you gave, I would say the buyers say, we either can't pay that and part of it is not only because we don't have the resources, but because we're fearful with what we see going on, or we won't pay that because we don't think that it's valued at that. And just with my experience running a construction company, and also I sold the house and bought a new house. I remodeled the house I sold before I sold it, and I went through a big renovation of the house I just moved into. So I've been dealing with a lot of subcontractors, and the prices they were giving me were outrageous. Just as an example, the drywaller at my new house, he comes in, sees what I framed up, and he says $19,000. And I'm like, man, I ran a construction company not too long ago. Like, I would get this job done for $6,000. Well, what I had to do was hire a buddy who had a construction company. He did his markup. He got it done for $11,500, and the guy that he subbed it out to probably did it for $8,500. But I had a clown coming in here telling me $19,500, and I said, that's just ridiculous. But I can tell you, talking to colleagues in the construction industry, the subcontractors in the construction industry are as bold as they have ever been in the last 30 years in asking for prices, and many times they get it. It's like throwing pickles against the glass. They don't care. You know, it's going to cost you this, and they're just throwing pickles against the glass because they know at the end of the day one of those pickles is going to stick, and they're going to be paid 5 times what they were paid in 2009.
Yeah.
I love the pickle analogy. I think that is awesome. Never heard the pickle analogy before. So everything's going to collapse. Everybody's going to be homeless. Nobody's going to be educated. What else are we doing? We're all going to starve to death. We're all going to go back to PVC pipes in our, if we can afford PVC pipes, in our backyards full of dollars that may or may not be still in existence. So basically, we're all facing Armageddon, which means that everyone that has the means needs to start a nonprofit so they can get donations, so the ultra wealthy can have all of the tax write-offs that they want, and they can support all the people that don't have houses, all the people that can't eat, all the animals that need to be rescued. You know, nobody wants a collapse. We've been in worse positions than this. We just have, and we've always gotten out of it, and I know that that's not an answer, but everything is, it goes back, to your point, to the individual. Make the individual choices that are going to make the small differences that make a bigger influence on the systems we have. Because what has happened is, to your point, sir, who's not paying any attention, the small charter banks are now gone, right? So they can't get the money, right? The small brokerage firms, has anybody even seen or heard of a discount house? No, they're all gone. So all the little guys that serve the people that really need the help, that really don't want to pay the inflated prices, are gone. How do we bring those back? New and innovative ideas, new and innovative, you know, even if it's crypto, or fungible tokens, or whatever it is, but we have to get back to, because the government doesn't work, and the big things don't work. Big banks can't fail. You know, it's individual choices that lead to bigger things.
Good.
You
Lyric.
told me to bring the human
To
element.
top
I
that.
brought the human element.
That's good. Lyric, you
I
get
don't
the
know how I
last
can
word.
follow that act. What I would say is something that worries me, and it goes back to the comments about construction and how much it costs, is we had the biggest fall in productivity this past quarter since 1947, 7.5%. To me, that's the canary in the coal mine. You pay more and you get less in terms of human labor. That's a really ominous sign to me. And I think we have to watch it. Maybe it was just one quarter, but it's really unusual. And productivity falls have been endemic in the United States for some time. So what is causing that? That productivity puzzle, I think, holds a key, but I haven't found that key yet. Going back to what I mentioned about silver, you know, in China and all of that, I think where another way that this has ended up, and where the Depression ended up, was in war, in global war. And that's a way that this stuff gets reset. And there's a new book out by the former Prime Minister of Australia, Kevin Rudd, I'm going to be interviewing him next week, and the book is really mesmerizing. It's called The Avoidable War, because we've never had a war, a nuclear war between nuclear armed states, and what that would mean would be very devastating. But if you look at what's going on in Washington now, the same neocons who are running us into Iraq, it's the same group of neocons who want war with China and war with Russia and war with Iran and everybody else. I think that if we make a certain number of additional policy mistakes, sadly, that's where we could end up. I would watch Eisenhower's speech. I commend to you to look at YouTube and watch his speech as he was leaving office about the military-industrial complex and the dangers. It's to watch someone that articulate who had been in battle and knew what war meant. I think it send shivers up your spine.
Yeah.
So that would be my last comment. That's my greatest worry. Not an economic collapse, but actually global war.
Yeah. And none of us want that. All right, we're out of time, according to the boss over here, Eric. So I want to thank all of our panelists for being with us here and virtually. And thank you all for your attendance and participation. And as we always do, we're going to be a bunch of us flitting around here, one lounge or another, and continuing the conversation. So thank you.
Thank you.
Bye-bye.